Welcome to our exploration of market structures. Today we're diving into two of the most important concepts in economics: perfect competition and monopoly. Understanding these structures helps us see how businesses operate, how prices are set, and how consumers are affected. Throughout this video, we'll break down the characteristics of each market type, compare their strengths and weaknesses, and see real-world examples. Whether you're a student, a business owner, or just curious about economics, this journey will give you valuable insights into how markets shape our world. Start with perfect competition. Imagine a marketplace where countless sellers offer identical products and no single seller can influence the price. In this environment, buyers and sellers have complete information, and anyone can enter or leave the market freely. This is the essence of perfect competition. It's an idealized scenario, but it helps economists understand how prices and output are determined when competition is at its highest. Think of agricultural markets like wheat or corn, where many farmers sell nearly identical goods. Perfect competition is defined by several key features. First, there are many buyers and sellers, so no one can control the market price. Second, products are homogeneous, meaning they're identical in every way. Third, there's free entry and exit, so new firms can join or leave without barriers. Fourth, all participants have perfect information about prices and products. These features ensure that prices are set purely by supply and demand, and resources are allocated efficiently. Perfect competition is rare in reality. Some markets come close. Agricultural products like wheat, corn, and rice are often cited as examples. In these markets, individual farmers have little control over prices, and products are nearly identical. Stock markets also share some features of perfect competition, with many buyers and sellers and transparent information. However, most real-world markets have some differences from the perfect competition model. One of the biggest advantages of perfect competition is efficiency. Because firms can't set their own prices, they must operate as efficiently as possible to survive. This means resources are used in the best way and consumers get products at the lowest possible prices. In the long run, only the most efficient firms remain and profits are driven down to a normal level. This creates a win-win situation for both consumers and the economy. Despite its benefits, perfect competition has limitations. It assumes all products are identical and that everyone has perfect information, which is rarely true in real life. Also, it doesn't encourage innovation since firms can't earn extra profits for new ideas. In reality, most markets have some barriers to entry, product differences, or incomplete information. These factors make perfect competition more of a theoretical benchmark than a common reality. Now let's shift gears and talk about monopoly. Unlike perfect competition, a monopoly is a market with only one seller. This single firm controls the entire supply of a product or service and can set prices without competition. Monopolies can arise from unique resources, government regulation, or technological advantages. Let's explore what makes a monopoly so different from perfect competition. Monopolies have several defining features. First, there's only one seller, so the firm has significant control over price and supply. Second, there are high barriers to entry, making it difficult for new firms to compete. Third, the product offered is unique with no close substitutes. These features allow the monopolist to maximize profits, often at the expense of consumer choice and lower prices. Monopolies can form in several ways. Sometimes a company controls a unique resource like a rare mineral. Other times, governments grant exclusive rights such as patents or licenses. Technological advantages can also create monopolies, especially when one firm develops a breakthrough product. In each case, competitors are kept out and the monopoly can dominate the market for years. Real-world examples of monopolies include utility companies, like water or electricity providers, where it's impractical to have multiple competitors. Tech giants with patented innovations or exclusive platforms can also act as monopolies. While some monopolies are regulated to protect consumers, others can lead to higher prices and less innovation. Understanding these examples helps us see the impact of monopolies on everyday life. One of the most important aspects of a monopoly is its power to set prices. Unlike firms in perfect competition, a monopolist can raise prices without losing all its customers since there are no close substitutes. This means consumers often pay more and the firm earns higher profits. However, this power can also lead to inefficiency and reduced consumer welfare. Monopolies are often less efficient than perfectly competitive markets. Because they face no competition, monopolists may not have the same incentive to minimize costs or innovate. This can lead to higher prices, lower output, and less choice for consumers. Economists call this allocative inefficiency, where resources aren't used in the best way for society as a whole. Let's compare how consumers are affected in each market structure. In perfect competition, consumers benefit from low prices and a wide choice of suppliers. In a monopoly, consumers often face higher prices and fewer options. The lack of competition means the monopolist can prioritize profits over consumer interests, which can lead to dissatisfaction and calls for regulation. Innovation plays a different role in each market structure. In perfect competition, firms have little incentive to innovate since profits are minimal and products are identical. In monopolies, the potential for high profits can encourage innovation, especially when protected by patents. However, once a monopoly is established, the lack of competition can reduce the drive to keep improving. Barriers to entry are a key difference between perfect competition and monopoly. In perfect competition, it's easy for new firms to enter or exit the market. In a monopoly, high barriers like patents, control of resources, or government regulation keep out competitors. These barriers help the monopolist maintain its position and profits over time. When we compare outcomes, perfect competition leads to the most efficient allocation of resources and the lowest possible prices. Monopolies, on the other hand, can restrict output and raise prices to maximize profits. This difference has a big impact on consumer welfare, economic growth, and overall market performance. Governments often step in to regulate monopolies and promote competition. This can include breaking up large firms, setting price controls, or encouraging new entrants. The goal is to protect consumers and ensure markets remain fair and efficient. In some cases, natural monopolies, like utilities, are regulated to balance efficiency with public interest. Markets are always changing. New technologies, shifting consumer preferences, and policy changes can transform market structures over time. A competitive market today could become a monopoly tomorrow, or vice versa. Staying aware of these changes helps businesses and consumers adapt and thrive in a dynamic economy. Wrap up our comparison, let's summarize the main differences. Perfect competition features many firms, identical products, free entry, and efficient outcomes. Monopoly has one firm, a unique product, high barriers to entry, and less efficiency. Each structure has its own strengths and weaknesses, and understanding them helps us make sense of the real-world economy. Market structures shape everything from prices to innovation. They influence how businesses compete, how consumers choose, and how resources are used. By understanding perfect competition and monopoly, we can better appreciate the forces that drive our economy and the role of policy in shaping market outcomes. In conclusion, perfect competition and monopoly represent two ends of the market structure spectrum. While perfect competition is efficient and consumer-friendly, monopolies can lead to higher prices and less choice. Most real-world markets fall somewhere in between, but these models help us understand the trade-offs involved. Thanks for joining us on this journey through market structures.